In this lesson, we'll continue building a trade using step 3 of our 6-step process, identifying zones. Let's recap where we're at so far. We started by setting the curve in step 1 on a higher time frame to set the stage for us, outlining the playing field. In step 2, we moved to an intermediate time frame to check the trend to see how price is moving within the curve range. This brings us to step 3. Identifying zones. In step 3, we'll move to a lower time frame to identify an entry zone to go with the trend and an exit zone to gauge our target. Looking at the example on the left side of the screen, we've moved the chart down to the lower time frame. The first step is we want to identify an entry zone. Since we found an uptrend in step 2, we want to look for a demand zone to join that uptrend. To do so, we'll use the 5-step zoning process, and in particular, we want to find the demand zone within the breakout segment of the uptrend. Now let's go through the zoning process, narrowing our focus to the green box on the right that connects to the controlling swing low. We start with the current price, which is always the candle farthest to the right on the chart. We look down and left until we find the origin of a big explosive rally in price. We isolate the base and draw the proximal and distal lines, and then begin to assess the quality of the zone using the zone structure odds enhancers of strength, time, and freshness. To assess strength, we want to see that the move out is at least 2 to 1 and that price breaks out of an opposing supply zone, or in this case, the preceding high. This zone only has one basing candle and is fresh. Once we identify the entry zone, we need to identify the opposing supply zone for our target. After identifying the entry zone and opposing target zone, it's time to evaluate the profit zone. We'll introduce the profit zone in its entirety in an upcoming lesson. But in short, let's measure the distance between these two zones with a ratio. We see we have at least a 5 to 1 ratio, which will ultimately allow for greater profit potential on the trade. In this lesson, to review, we covered step 3 of the 6-step process. In step 3, we identified the entry zone within the breakout segment of the trend using the 5-step zoning process. Then, we found the nearest opposing zone for target placement. Once we have those two zones, we evaluate the profit zone. This wraps up the technical steps of the 6-step process. Next, we'll begin to set the trade and place the order. Before you move on, continue utilizing the same chart you used from previous lessons and find a low time frame entry zone and a low time frame target zone. In an uptrend, going from right to left on the lower time frame chart, identify a demand zone for entry within the uptrend's breakout segment. In the uptrend, identify an opposing supply zone for a target, and also evaluate the profit zone between your entry, your stop, and your opposing target. In a downtrend, going from right to left, on the lower time frame chart, identify a supply zone for entry within the breakout segment. Also, identify an opposing demand zone for your target. Lastly, evaluate the profit zone between your entry, your stop, and your opposing target. In a sideways trend, look for either your supply zone at the high end of the major down segment, or look for a demand zone at the low end of a major up segment. Hope to see you in the next video.